Good morning. I'm really pleased to welcome you to the first conference of the 19th Private Equity Exchange and Awards. This is as well the first edition in Phygital, and I hope the last one with a mask. Sorry for that. Today you will have the opportunity to attend the virtual conference program and debate the latest topics with key leaders of the private equity and restructuring industry. We will be live all day, but if you miss conferences, you can rewatch them on the website of the event. They all will be in replay. To start your day, maybe with your first coffee, I have the pleasure to have with me 4 experts on my left who will present themselves, starting with Nicolas.
Good morning, everyone. My name is Nicolas Di Giovanni. I'm a partner at Winston & Strawn Paris, and I'm in charge of the private equity department at Winston. And I'm very pleased to be here today.
Philippe.
Good morning, I'm Philippe Crochet. I'm a partner at Kinside Capital, a private equity fund focusing on fast-growing and profitable companies in 2 sectors, tech and healthcare.
Guillaume.
Good morning, everyone. My name is Guillaume Jacot. I'm the managing partner of Equistone Partners Europe, which is a mid-market player with a presence in the UK, Germany, Benelux, Switzerland, and France. I'm very pleased to be there with you today.
And last but not least, Jean-Luc.
Good morning. I'm Jean-Luc Alavena. I'm the chairman of Atlantis Investors, which is advising and co-investing with private equity funds and primarily Apollo Management.
Thank you very much to all 4 of you to be with us today to talk about the delicate topic of the art of timing when it comes to exit. If you have any question behind your computer, you can ask them during the conference on the chat, and we will take a few minutes at the end to answer it if it's possible. Let's start with the vast but very necessary question: how to make the decision of to hold or exit an investment. Who wants to start?
Happy to start. Not an easy question. Exit is not a perfect science, like private equity, by the way. And it's probably a couple of criteria which you have to take into account if you want to make a successful exit. I think the main areas to take into account are, first of all, the timing of the exit and when you have to sell the business. I think you have to sell the business before it is at the top. So you need to sell a business with a growing trend. That's the first thing. So that the right timing and in the right timing in terms of growth cycle. The other element is the management, of course. You need to make sure that the management will be in line with you and will be with a strong alignment of interest and will agree on the exit, because I think it's impossible to sell a business against the management. And the other thing is the market context and many other elements like the financing market. You can sell a very nice business if you have no bank debt. That would be a problem. So you also have to take that into account. So I would say the trend of the business, the management position, and also the market context. That would be, to me, the 3 main criteria to take into account.
Jean-Luc?
Well, obviously, these market criteria are key, and the management is key. I would add 2 other criteria. First of all, is when has the job been properly done. When you start a deal, you obviously have an idea with the business plan, with all the actions, with the performance improvements of the work that has to be implemented in order to increase the value of a company. So when is this ready enough? When you do a large carve-out, you obviously it takes 1 year, 2 years in order to organize a company as a standalone company. So when is the work done? And as Guillaume said, when is there enough additional potential for the future for a new equity story? And secondly, apart from external reasons, internally, when do you need to sell? There is a discipline, which means at some point a company which is ready to be sold has to be sold. But secondly, according to your own fund, the need that you have to give money back to your investors and many other internal criteria. When do you have to do it? So I think it's a combination between the market, the work that has been done within the company, is it ready to be sold, and your own constraints depending on the lifetime of your fund and what you have to give back to your investors, and so your own reasons to sell or to keep going with the company.
Philippe?
Well, personally, I would, I think, consider things a bit differently from my two colleagues. Well, at Kinsight, we invest in fast-growing companies that generally rely on very strong market trends. So as a result, basically, as they are both growing and generating quite a lot of cash flow, we could basically sell anytime. And that's, I think, what is our strength. When we decide to sell, well, basically, we can sell. There will be a buyer. And at the same time, I would say if your company creates value, the more you stay, the more value you create, of course. So for us, the difficult thing is always to decide when to sell, considering the fact that if we decided to stay, then we would create more value. So as a result, it's generally a mix of when we have reached what we assume to be our value creation milestones, and when at the same time, I think there is a desire maybe from the management to also start a new investment cycle. And that's when generally we decide to sell. But practically speaking, of course, within the shareholder agreement, and I'm sure Nicolas can well, go more into details about that. Within the shareholder agreement, you always define a liquidity event. But as a matter of fact, most of the time, we are approached by potential buyers way before this liquidity event horizon. And as our companies are fast growing, we are also able to reach our value creation milestones before this liquidity timing. So as a result, as I said, it's really a mix of deciding when it's a good time to send money back to our LPs, having reached, well, the correct value creation milestones.
Nicolas, you have a big picture and a legal point of view.
Yes, well, obviously the main drivers to decide when to sell a company or not to sell it, those are business drivers. I mean, Jean-Luc, Guillaume, and Philippe have explained from their point of view as investors when it's relevant to sell, and basically those three investors have three different profiles in terms of market, in terms of type of businesses, so that's why maybe there are also some different criteria. From a legal standpoint, there are elements which are to be taken into consideration when you decide to sell. Those criteria are not, I would say, the drivers which would push you whether or not to sell. But they would be taken into account in order to postpone the date of when you start your process. When you have to iron out issues, for example, when you have to, Jean-Luc told about the carve-out, but you can have reorganization. You need to prepare your asset, and preparing your asset can also delay the moment when you want to sell the companies or your portfolio.
Okay, thank you. So exit is not a perfect science, as Philippe said, and we talk about timing, management, market, the work done in the company, the constraints, exogenous constraints, the value. What are the other criteria that you look at before to decide to exit or not? Jean-Luc?
Well, first of all, you have to decide the kind of exit. And obviously, as you just mentioned, there are so many different kinds of investments. For us, obviously, it's a large buyout traditionally, but it means that you have to decide, depending on your opportunities, between an IPO, between selling to a strategic, to another fund. And that's the first major criteria. How are you going to do that? Which means, depending on each option, do I have opportunities, and is it the right timing? So obviously, then you have the criteria of the timing on the markets, which you may not have if you sell to a strategic or to another fund. So the balance comes from the choice of the kind of exit which you think will be appropriate for the company and give you the best returns. Secondly, how and when is it feasible? Which kind of process do you have to start, which means many other legal and financial questions. And then, as I said, it has to be, and I think for our business and private equity in general, investment in general, it's important not only to have financial criteria, but social ones and also the perception. You should not have an exit which is too early, even if it's very opportunistic, because we always have in front of us people telling us, how long are you going to stay as soon as you invest? It's a question that you have immediately when you start speaking to a company about a potential investment. And our activity in general has also to work on its own image. So being capable of holding, working in depth, and delivering to the market or to other buyers, companies which have been really prepared for this is also, for me, very important, which means a few years later, you have to be proud of the exit that you did, and you have to make sure that it's in the right hands, not only sold in the best timing with the best performance.
To complete the picture, I think what you have to discuss in detail prior to the exit is what will be the next equity story. And this is something you have to discuss internally, but of course with the management. And when you talk about the equity story, you may realize some elements that you sometimes don't have in mind, and you realize that maybe you need to accelerate the consolidation, or you come to the conclusion that maybe there is no natural private equity solution, and you need a trade solution. So, but to realize that, you need to have this discussion. You also take into account, of course, the alignment of interest, and you may realize that the manager is willing to reinvest massively. In some case, you may realize that he wants to retire. So these things are very important to discuss. And at the end of the day, the ideal world is to agree with the management on the ideal solution. So is it a private equity solution? Is it a combination? Is it a trade solution? All these things have to be discussed. So it's very much about preparing the various options and, if possible, agreeing on the ideal exit solution.
Yeah, no, I mean, I fully agree with what has been said, and especially with what Guillaume has just mentioned regarding the equity story, because basically what you will sell, it's not necessarily the financial criteria at the day of the exit. It's also the story that the management will build in the next phase, because that's basically what the purchaser will buy, basically. So being able to sell a growth story even after you have sold is obviously extremely important. The other thing, I think, because we spoke about alignment with the management, it's not only about the kind of financial incentives you have built for the management. It's also about making sure that you are aligned in terms of the exit you are actually preparing. So the communication is absolutely key. And I think that's why it's extremely important to have a very strong partnership with the management so that there is no miscommunication about what you are trying to achieve when you try to do an exit.
Well, when I hear Jean-Luc, Guillaume, and Philippe, I mean, what we can understand and what strikes me out is that an exit needs to be prepared, and you have to work on the equity story. You need to understand the market, and as Guillaume said, this is not an exact science. So all of this is totally different from one deal to another. But when you're a lawyer and when you assist your client, when they buy the company, and at the very beginning of a transaction, when you enter the deal, as Philippe said earlier, you work on the shareholder agreement, but right from the very first day of your investment, you've already worked on the exit, because you provide in your shareholder agreement how the exit is going to happen. Is it going to be a drag along which is going to happen? Which route are you going to take? Is it going to be an IPO? All of this. So the exit is prepared all along the investment, but even before the life of the investment, at the very beginning when the investor buys the company. And that's when you prepare, you pave the way and make sure that you control, because that's what you guys want at the end of the day, that you control the exit.
Well, you have to have the certainty you will have an exit option.
Exactly.
Definitely, especially if you're not the majority shareholder, which also happens in our business. Obviously, for each of us, every time there is an investment analysis, the key question is how are we going to do our exit? I mean, you think about it before you put your money at work, obviously. And at this time, you have a sum of options that you have in mind. Some of them are part of agreements at the beginning of a deal. Then there is always the uncertainty. But it's clear that for most of us, a successful exit means it has been well organized and anticipated from the beginning. And indeed, you never do an investment when you don't know at least how you're going to do it, probably when, on which kind of criteria. I mean, doing a good investment is thinking about the way you are going to sell.
How to decide whether to exit, but according to exogenous constraints that do not depend on the investment itself, but on the constraints that you can have in a fund?
I think you have to find the right balance. It's very much about finding the right way and take into account all the constraints. And the constraints are not only on the fund side, they may also be on the management side. As I said, the CEO may be willing to retire, which is a constraint which you have to take into account. So you have to take into account all these constraints because they're part of the picture. And then, again, it's not perfect science. You have to try to deal with these elements and find the right balance for everyone. At the end of the day, I think if there is a good alignment of interest, and the alignment of interest is the basis of private equity because you share the profit, I'm pretty sure that if you have a nice asset, you will find a solution. It's very much about communication and transparency. If you are very transparent about your constraints, if the management is very transparent about his own constraints and his desire, I'm sure you can find a solution. If you hide anything, if you have a hidden agenda, that will create some problems on both sides. So you have to be transparent. That's the key.
And maybe to add something, I mean, Nicolas was speaking about controlling the exit, and I don't think you can control the exit against the management. So basically, for me, controlling the exit is not really about deciding by myself when I'm going to exit, because it's a common project with the management. But what I mean by controlling the exit is to make sure that you actually don't depend on exogenous event, and you want to control that timing. That's the most important thing. And one of the best ways to achieve this objective is to invest in companies that you can exit whenever you want, basically, because they are growing, so they will continue to create value if you keep them within your portfolio, and because also they generate enough cash to be able to don't suffer from any constraints in terms of, for example, cash generation. And if you have this kind of characteristics, then you can decide to wait maybe 1 more year, or maybe to sell 1 year before, if it gives you more control on this exogenous event. And I think that's the most important thing, basically.
I agree with Philippe, because you never know what's going to happen in the life of your investment. You can never be protected for any change in the regulation, any litigation with one of your shareholders or managers who retires, etc. So, you need to adapt on exogenous constraints and events, and try to iron out the issues. And if it's not possible, as Philippe said, well, this probably will affect the calendar of the exit, and you will probably need to postpone your exit. So there is no rule, I believe, when you're hit by, the pandemic is a right example. There is no rule. And I think that it's about how you react and the quality of your team who adapts to the situation and finds the solutions.
Thank you, Jean-Luc. I think the ideal situation is to have the choice. So when you have the choice, maybe it's more complex because you have a lot of discussions with your partners and with the management, but when you have the choice, you are probably better positioned to find the best solution. So a successful exit is probably an exit where you have the choice. You have many options and you can decide which one is the best one for everyone.
It's true.
Jean-Luc?
Well, definitely, and when you decide to do an investment, it's the same. You always think, do we think the future equity story will work with an IPO? Are we going to have strategic buyers or not? Are we going to have financial sponsors coming in? So indeed, then at some point you have to take your decision and then you become at risk. If you want to be more precise, I remember you had invited us exactly for the last forum a year ago after the successful IPO of Verallia, which is a very strong company. The work had been done, everything was ready. You have to be humble. During a week or 10 days, you may also have, and that's what you consider as exogenous, which is what can happen that you can control. Obviously something on the market. And we all know that when we decide to go for an IPO, the window period is, first of all, usually very short, and secondly, it's much more risk than you would think, because even the best company with the best equity story, very good results, will have a successful exit through an IPO if the market conditions and the perception are good at that time. And even the best company may find itself during a week or 10 days. It's really this, when you've decided to go ahead, you still have a storm of uncertainties. So you have to control all this, and you have to have around you, apart from your team and the company and the management, you also have to have the best advisors. You have bankers and lawyers who are very good at that and who give the right advice. And that's my tribute to Nicola.
Yeah.
And we should have a banker with us too. But I make a huge difference between the teams in these circumstances for large deals who are capable of comforting the thesis that you have and the equity story that you're selling. And there are good and bad teams, which means at the end of the day, you also have to pick up the best people around you. And again, even if you think that the company you're going to sell through an IPO is the best one, is resilient, the story is clear, and so that's also in the balance. We're not only investors, we also have many people around, and we have to pick up the best ones.
Indeed.
Nicolas, you agree?
Oh, I agree. Obviously, I mean, I totally agree with Jean-Luc, and I think everyone here in the room does.
How to align the interest of the stakeholders and how to manage the disagreements?
Well, there are two, I think, in my opinion, there are two aspects to your question. The first one in terms of how to align interest. I mean, there is one thing that the LBO industry does well. It's creating tools that actually align the interest, and I think that's one of the main qualities of our industry. But then it's not enough, because most of the time the managers, and especially if they are founders of the company, they also want to make sure that the project they will get into after we have sold our shares is also exciting for them, whether it's a corporate buyers or a financial investor. So that means that in order to make sure that all these different parameters go well together is to have a good communication. And as I think it was Nicolas mentioning it, this dialogue must start way before the 6 months during which you will implement the exit. And for me, well, the best way to try to avoid any disagreements is through really a long-term communication on what the exit will be and what the next equity story will be.
Yeah, I agree with Philippe. By definition, private equity is able to align interest. In some cases, it is more difficult. I think at the end of the day, all private equity investors are aware of the fact that their reputation is important, so they have to behave in a way that will enable them to work again and do other deals. And that means that you have to manage the exit properly. And the ideal world is to have managers who are as happy as you and who will recommend your fund. So I think that's quite a strong element that will ensure that everybody will be happy at the end of the day. You cannot control everything. You cannot control the future. You have to manage emotions, and I think we're all aware of the fact that exit generates anxiety because there is a lot of uncertainty, and uncertainty creates anxiety. And you have to deal with these emotions on the management side, and I think that's very much related with the experience of the fund and the fact that we want to keep a strong reputation.
Nicolas?
Yes, Jean-Luc, you want to?
Please.
Well, I mean, something which is, you have the legal tools to as Philippe and Guillaume said, to align your interests with the management. You have various contractual tools, but at the end of the day, if it's very hard to go against a hostile management, as you said. So you need to very well understand the needs of the management and align yourself with the management in terms of liquidity event. Is it going to be an IPO? Is it going to be a sell to a trade buyer or another secondary or third LBO transaction? So I think at the end of the day, it's a human understanding. You need to, and again, it's one of the key criteria in your business is that you need to choose the right management, because you don't only have the fundamentals of the asset you're buying, but you're also buying the company with the management. So I think that this alignment of interest is also made at the beginning of the deal, because you have chosen the management which you deemed was a good one and which you deemed was aligned with you in terms of spirit and philosophy of investment. So I think it's the hardest part of your job. It's a human one, when you need to make sure you've picked the right team.
Well, I think your question has to be divided into several questions, because where can the disagreements come from? From the timing? Is it too early, or might I be too late? Secondly, who are you selling to? And third, how do you drive this process? It means that from the beginning, if you have determined with the management that there is a story, there's a plan, and there's a time frame, you limit the number of issues that you may have at the time of the exit. I think the most difficult one, because usually we are backing a management when we do a deal. So if you're behind a management, if you're supportive for a management, it means you do everything you can in order to make sure that you're going to be in agreement. The timing is not really a question for disagreement, because the perception of the markets, the analysis of the potential of the company, everything is very rational. And I've seen limited disagreements in that field. The question is mostly, are we going to sell to a strategic buyer, and what is the consequence on the management, or are we going to sell to the market or to another fund, which means for the people remaining in the capital of the company, it may be a completely different life. And obviously, if you have a very successful deal, it's going to work anyhow, because everybody will be aligned for the best. It's critical when the performance of the company has not been sufficient. And as a fund, if you've been an investor for a number of years, you have to exit, because you can't stay forever. So the way you resolve this is, I think you said, the transparency and the maximum amount of internal discussions, sharing the same information, having everything on the table. Secondly, and it goes back to, and don't think I've been paid by Nicolas or other bankers, but I think the intermediation done by good advisors is key in these circumstances, because they can give an objective and rational opinion about the various criteria. And don't forget that some deals are also with not only with the management and an investor, but we have done a number of deals with institutional investors like the BPI. You have a very long-term investor and you don't have the same time frame, or with a strategic partner, which was the case at the time for Constellium with Rio Tinto, for example. So in the middle, you have to make sure that year after year, these topics are discussed on a regular, permanent basis in order for everybody not to have any major surprise when the time of the exit has come.
You told me that it was very important 2 or 3 years after the exit to look back. Have you ever been disappointed by your exit? It's hard to tell.
It's hard. Yeah, there are situations where you feel that the management is not as happy as you hoped he would have been. But there are things you cannot control. You cannot control the fit between the next shareholder and the management. This is something which is difficult to predict. It's fair to say that a trade sale generates more uncertainty because the company is moving into a different model. And I have examples of a trade sale which have been very successful. We sold Aerocan to Ball Corporation, a large US packaging company, and the management was very much in favor of that, and they were very happy with the solution. There are other situations where it is less easy to judge because there has been some strategic decision from the trade buyer which you cannot control. And I think at the end of the day, if the new shareholder is not able to retain the key people, that's a problem. And so there are situations where the fit or the strategy moves from the initial point, and again, it's not really your responsibility, so difficult to judge, but not as successful as what you hoped initially.
Maybe to answer your question again a bit differently, as Guillaume rightfully said, I mean, you cannot necessarily control what happens during the 2 or 3 years where you are not a shareholder anymore. So for me, the question is more, 2 or 3 years later, what kind of relationship do I still have with the management that I used to back? And that's the most important part. And from that perspective, what I can tell you is that within KINSAT, well, we keep excellent relationship with the management once we have exited. So I think it proves that, well, during the time where we have been shareholders, and also the way we have managed the exit with the management must have been, I guess, seen from the side of the management as the right way to do it. And it's very important for us to keep these relationships. We have a lot of CEOs that with who we entertain relationships. They can either become investors within the next generation of our funds, some become operating partners of KINSAT, we have a lot of different kinds of relationships with the management that go sometimes well after these 2 or 3 years. And the capacity, I think, to build this ecosystem based on the management you have backed is extremely important. And that's something of which we're extremely proud at KINSAT.
Well, I'm very happy you asked this question, because I think we have to be realistic. The reputation of our industry is not that good. I mean, we're always under scrutiny, and many people are checking, are these investors just here to make money? And what can they find in the way we drive our business, our investments, that wouldn't work? We know that. This is an industry which is not perceived very well all over. Which means when you look at your own companies 3, 4, 5 years later, we all hang around with presentations of our funds where we have the track record. And the name remains in this track record, which means 2, 3, 4, 5 years. It's really when you can see if you've done a good job or not. And obviously, people who have followed you may have done a bad job, but in this case, you have to be able to explain it. And a few examples on the top of my mind where we've done exactly what had to be done. The exit was perfect. You then pass over and hand over to another investor, and 2 or 3 years later, they've made a mistake, but it's the same name of the company that you invested in, and you have done a perfect job, but you've done it. So in the choice of your followers, you also have to think about the capacity they are going to have to do a good job and make new step forward for the company, because in your track record, you're going to live with these names and with these companies. And I think the more we will pay attention collectively to the sustainable performance of the companies we invested in, the better. Because we know, and especially at the size of deals that we do, we know that every time we arrive and jump into a new situation, people are trying to understand who are these people, especially you're here in France. Obviously, we're based in London and the US. Are you a foreign investor? You know the environment, you know what's going on here. And you have to make sure that when you introduce yourself for a new opportunity, people know that your reputation, your track record has not only been to deliver good returns to your investors, but to do a great job within these companies. And if I push one step forward, we'll have now commitments on social commitments and some of the things that we have to do, which are not quantitative but qualitative. And this makes our industry more, and will make our industry more respected and more attractive. So looking at the deals a few years later, checking how the buyers have been doing, how the management has been performing, means when we start a new deal, it's an additional credential. So I think the question you ask is a key one for an exit. You're just not doing, take the money and run. This is over.
To illustrate Jean-Luc's point, on which I fully agree, I think we've all experienced that. But when we meet a new management team, when we investigate a new investment opportunity, in every case, they ask us during the first meeting, how do you manage exits? And can you give us example of recent exits? Because they want to understand how we deal with the exit situation, because it's absolutely critical for them, for us, and for the future of the partnership. So we have to be transparent, we have to behave in a very fair way, and we have to think about our reputation. And exits are absolutely critical for the private equity reputation.
Yeah, and maybe to add a last point, going into the direction of what Guillaume and Jean-Luc said, most of the times when we do a deal, the management of the company we try to invest in ask for references. So they want to speak to our previous CEO. So if you have behaved poorly at exit time, or if these guys are not happy, then you have an issue. And that's why you want to keep all this ecosystem happy.
When I hear Jean-Luc and Guillaume and Philippe, I mean, another criteria of a good exit is to make sure that you choose the right buyer. Because as you said, it's part of your reputation, it's part of the work you have done. You don't want to see this work which you've spent money, time, and energy to be wasted because you've chosen the wrong buyer. And at the end of the day, this would affect the track record, this would affect the reputation, and actually it's a very good question.
And one of the best tests, by the way, is as soon as you prepare this kind of exit, you go and see the unions, which I do systematically. It's a very good test. What is the perception of the equity story and the exit story that you have in mind from the people who are working in a company and representing the employees of a company? What's their perception? And by the way, there are very good surprises. Some of them say, yes, we're supporting the IPO because then, we want to become shareholders. But this dialogue is very important. And again, I think it's key for the future of our industry, especially for the authorities in each country, the regulators, the supervisors, the ministers. Whenever there is a significant deal to do, they want to know how you have taken into account in the past a certain number of criteria which are your responsibility. So it's not only about return. This is clearly the target that you have, your responsibility towards your limited partners. But the other one is, how do you build a franchise which is taking into account all the other criteria? And for an exit, the choice of the buyer is key, apart from, obviously, when you talk about an IPO. And you have to make sure, and the price becomes still the major element, but it has to be balanced with the other criteria. And again, your track record is not on D-Day. It's 3, 4, 5 years later. Did we do a great job within a company? Did we find the right buyer to take this company one step forward? And what have we done in order to make sure that the transition is smooth and the future of the company, which is our mutual responsibility, is guaranteed?
And Jean-Luc, does that mean that when you are in an auction process, you have several buyers, that obviously you'll try to make the best pick in terms of brand of the buyer, but you will also look at the conditions, the financial conditions, the leverage the buyer will put to make sure that it's not too aggressive and that the company will support it, and that you don't end up a couple of years after with what you try to avoid, which is a bankruptcy situation. Definitely.
Yes, but yeah. And on top, of course, I mean, but you know it. We are not the only one to decide. I agree with what Guillaume said, which is you don't sell against management. So as a result, if the project does not fit well the management requirements because there is too much leverage, or well, it's also a discussion that the management will have with the potential buyer in order to make sure that the management also supports their bid.
Of course.
Yeah, if the solution is not well accepted by everybody around the table, it's very likely that you will face problem going forward. So.
Let's talk about reinvestment. What are the interests, and is it difficult to to get everyone on board?
Oh, so maybe I can start. I mean, you mean reinvesting in a company that we exit, right?
Yes.
Okay. Well, it's there are obviously benefits to a reinvestment in a company that we already know. Of course, well, first of all, you limit a certain number of risk by the fact that you actually know the management and you know the company and you know how solid the equity story is. So from that perspective, in terms of comparing it to a new deal, of course, you reduce the risk. The other benefit can also be to potentially exit part of your proceeds and make sure you secure a certain level of returns and then still benefit from upside in the next phase of the investment. And lastly, it's also a good signal for the purchaser, the fact that you want to go on. So it actually can also help to make the exit process successful. Because if you want to stay on board, that means that it's a good deal, right?
I think it's a reality test of the balance, the right level, and the right balance. If the management is willing to invest a massive amount, that's good news for the buyer, but for the seller, it will raise some questions. If the management is not willing to invest, that's still more problematic, I think. So it's really a question of balance. We have to be pragmatic, and there are some kind of market practice in terms of level of investment, which we all know, and we have to be in a normal range of investment, I think.
Jean-Luc?
Well, I don't like reinvestments. Try to avoid them by all means. I'm happy if we do a deal, I'm happy to welcome previous shareholders if they want to come alongside with us. But then we have to determine a time frame, do the job, and exit. Obviously, if you do an IPO anyhow, you're going to exit step by step. If you sell to a strategic or to another sponsor, which is limited number of the deal that we do.
I was talking about management for investment.
You do it one shot. That's for us.
Okay.
Concerning the managements, it's obviously, and you answer the question, it's completely different story. And indeed, it's part of the history of companies to have a management across the life of a company, and 2 deals, 3 deals, successive ones. Again, usually there is, for me, that's what I'm saying, I don't like that. I'm not working a lot on this, because when most of your exits are on the market, then the management has a different life. So they do their cash in when the management plan is done, and they move to a different life. 80% of our exits are on the market, so it's a different approach.
Yeah. On the fund reinvestment, it's a complex question. I do understand what Jean-Luc is saying, and I think there are quite a lot of LPs who don't like reinvestment. They don't like the idea that a majority fund remains a minority investor in the next deal. I think it's case by case. There are situations where when you have a nice asset, a nice company with a strong management team and with a strong alignment of interest for the next equity story, there can be a merit in reinvesting a marginal amount. I think it's really case by case. So I would prefer to remain open on the concept on reinvesting, because there are situations where I think there is a strong interest in doing that.
Yeah. I mean, I fully agree with what Guillaume said. I mean, on this front, we are totally we have a very pragmatic approach, but we do it on a regular basis. And for example, the one exit we did last year in the middle of the COVID crisis, we sold a Smart Trade to HG Capital, which is a tech British fund, and we decided to remain as a minority shareholder. I mean, we secured a very nice return based on this first exit, and then we still benefit from the next upside phase. So actually we are quite open to this kind of questions. But as Guillaume said, it's really a case-by-case discussion.
And I agree, it's a case-by-case discussion. There is no rule. At the end of the day, you guys remain open. But what we can witness from a legal point of view, that, as Philippe said, when the seller reinvests, it's a very good signal for the buyer. But it also has some benefit for the seller, because it could make the process easier for the buyer. And for the seller, you could sell at better conditions. You could have a limited warranties, because you're putting money. Again, you still have skin in the games, so you can trade this against not putting any warranties and not to hold liabilities for your investment. So this could be one of the advantage of reinvesting. But again, I agree, there is no rule. Every deal is different, and every equity story is different, and then investors adapt to the situation, and they adapt whether or not they need to reinvest and show that they have trust in the asset, or and then put back money or not. It depends. There is no rule.
Yeah, but and so just to conclude, because actually within this question we mix two different things that are the fund reinvestment, which we just discussed, and what Guillaume discussed at the beginning, which is the management reinvestment, which is of course quite important, especially in these times where if the management takes a significant amount of proceeds at a time where the best investment he can do is certainly within his own company versus other investments that will be less profitable. It's kind of a weird signal if they don't want to invest, not necessarily the entire proceeds, of course, but at least something that is significant.
Have you ever been able to sell a company where the management didn't reinvest?
Well,
except for a trade sale?
Yeah.
Well, that's what I'm saying. It's obviously, if the exit is to another fund, usually you're going to ask people to reinvest. What I don't like, and I expressed at the beginning for the individuals, apart from the investors, is that, and I've done my own buyout. Before joining private equity, I've been the CEO of a company which has been through 2 buyouts. And you end up, if you have 2-3 steps, you end up with people who are not completely aligned between the newcomers, the founders, the former investors. I mean, there are also difficulties. There is a rationale, which is you make some money, you reinvest because you strongly believe in the new plan, and you show your new investors that you're going to have full commitment. On the other hand, you have a population of managers which becomes a mix between old, current, future. It's not very easy to align. I mean, that's my feeling. But again, it's clear that when you're a fund and you buy from a fund and you have a management which is necessary for the new deal, you're going to ask them to reinvest.
Of course.
It concludes our conference. We are already time out. Thank you very much to all of you for your experience and to have take a little hour to discuss this important topic of the art of timing when it comes to hold or exit. Thank you very much.
Thank you.
Thank you very much to have followers for this first conference. Don't miss the other one. You will have plenty of them during the day, so stay with us. Thank you.
Thank you.
Thank you. Merci beaucoup.
Merci beaucoup.